Hi, welcome good people. My name is Joshua. This is the Macha Connect show. I told you this is a place whereby we give you a chance to listen to the biggest minds in town. And today I'm hosting a friend of mine. I'm hosting somebody I've known for quite some time. His name is O'Brien. He has good knowledge on this matter that we are discussing today. Now, make sure you subscribe, you like, and share so that other people may receive this information. I'll let my guest introduce himself.
Thank you, Joshua, for having me on the show. I'm honored to shape the discussion on money matters and personal finance. My name is O'Brien Daku, and I'm glad to be here.
Thank you. Today we are discussing a very critical topic, the money market fund. This is something every person would want to hear. Every person would want to listen to. Every person would want to hear something of this sort because it touches on matters pertaining investment. Now, on to our discussion. Now, if I could ask you, Mr. O'Brien, every person would want at one given time to have that financial ability to do things. Now, can you walk us through the journey of from financial, I would say financial reliability or financial freedom to investment, then now we shift to the money market?
The journey to financial freedom. If I begin from the end so that we can connect from the beginning, financial freedom is a state of your financial wellness at a point where you have no fear over money. Your investments are reliable enough. They are generating sufficient cash flows that can take care of all your needs. Your lifestyle needs, your aspirational needs, your legacy needs, and enough that you are able to leave enough behind for the people who matter most to you. To acquire financial freedom is a journey of delayed gratification, is a journey of sacrifice. And the most important thing in your journey to financial freedom is your ability that you get from your income. Your income is the most important thing in your journey to financial freedom. Whether you are generating your income from employment or you are getting it from business. If you don't take care of that income, you have already destroyed what enables you to acquire that freedom after given prolonged period of time.
Now, this one brings us to the topic of money market. Now, if I could ask you now, for somebody who doesn't have this much information on money market, what is money market?
Thank you for the question. And one thing that I want you to keep note of is the income is the ability to generate or to build assets, because that is what we shall be coming back to in every other discussion. So to answer your question on what is money market, then we need first to look at that word, the way it is framed, a money market. And the first one I want us to look at is the market. What is a market? And a market is a place, whether it's going to be physical or electronic, where you are going to find two important parties. A party who is buying and a party who is selling. Then the other word, we have money. So this is a market that is dealing with money as the commodity that is being exchanged. And we are exchanging this commodity money for consideration. And there are two ways that you are going to exchange money in this market. There is a person who is looking for resources in the name of money for purposes of building or expanding their business. Then there are those persons who want to give away their money to such persons who want to use it for business expansion or creation of their business. What we use for business, that is what we call capital. So in essence, what we are talking about here in expanded mode would be a capital market. Therefore, money market is a part of a capital market. And the money market is reduced as the segment that deals with short-term capital. Monies or instruments that are exchanged in this market are ones that mature in a short period of time, that is merely up to 12 months or 1 year, but through the regulator, the instruments here have a extended maturity of up to 18 months. So in this case, for the money market then, we are talking of an environment where money savers are making their resources available to users of those resources for consideration. And the consideration here will be what will be paid back to the owners of the money, who are the sellers in this case, by the buyers.
Then, when you talk about the money market, this thing feels like, how is it different from SACCO?
A money market and a SACCO, I will differentiate them in this way. A SACCO is simply a financial institution that bridges the gap that was left by banks. SACCOs came to bank the unbanked. But a money market, this is a professional environment which is different from a SACCO or even a bank. But a bank and a SACCO can be a player in this market. Because if you look at it in a better way, a money market, the players here are professional registered institutions, the ones that we call fund managers. And that is the best way to approach a money market. And in the recent times, because investments were a preserve of the rich, but these segments have been democratized so much to bring inclusivity that enables a retail investor, the small earners, if I can call them by that name, to be able to access these markets. A person a long time ago, the least you could invest in this market used to be in millions or $1 million, but today, through the regulator, which is the Capital Markets Authority, the minimum amounts that you can invest in a money market have been reduced over time to today's laws of 100 shillings. That is to financially include the low income earners, for them also to get an opportunity to slowly start their journey of wealth creation for financial freedom in their own abilities. So as your question was about a SACCO and a money market. SACCO is an institution that will mobilize resources from its members purposely to on-lend the same members. In a money market, this is different from SACCOs. In a money market, we are looking for capital. It is businesses that are looking for capital. It's not individuals who come to this market to get resources from other persons. And to approach or to invest in this market, you need to go through another person. We also have opportunities where, as an individual or as an entity, you can approach the market in person as a do-it-yourself. But in most cases, we are supposed to go through intermediaries in this market, and these are the fund managers. And what happens with the fund manager? The fund manager will aggregate, will collect investment funds from different persons, and as per their policy or their requirements. There are minimum amounts that you will vary from one fund manager to another.
Okay. If I could ask, if we could put this into layman understanding. Now, from our understanding how market works, like where we go buy, sell, and such kind of a thing, the prices and the control is controlled. It changes. It's automatic, based on different times of the year, different things. There are so many things which affect the prices. So it is not centrally controlled. So if I could ask, because money market looks like it behaves the same way now, who controls the money market? Is there any central control of these kind of funds, their flow, fluctuation, and such kind of a thing?
Money markets, or the money market, constitutes of a key player known as the fund managers. And the fund managers, the fund manager himself and the products that they sell, they are registered and regulated by the Capital Markets Authority. And that is one of the most important things that as an investor through the fund manager, you are supposed first to ascertain whether the fund manager in question and the product, the money market fund itself, or any other products, because there are a number of products that fund managers will sell that are used as vehicles to access that market. You are supposed to ensure first that that fund manager himself is registered and the products are registered and regulated by the Capital Markets Authority.
Now, if I could ask, where is this money invested?
When fund managers collect and put together what they have gathered from us as different investors, you bring in your 10,000 shillings. Another person has brought in 100 shillings. Another person a million, 100 million. All that money is put into one basket. And as per regulation, money markets are only supposed to be invested, or the assets that are available for investment are instruments that mature in a short period of time, which is pegged at 18 months maximum. And therefore, the instruments that will be available, one, the key user of capital in the money market is the government.
Okay.
Government runs itself as a business. So government sells or issues instruments that we call treasury bills and treasury bonds. The fund manager, in case of treasury bills and bonds, he has a limit, upper limit to maturity period of up to 18 months. The other players that use capital from the money markets are quoted companies. These are companies that are listed in the stock exchange. Those companies, just like government, issue commercial papers and corporate bonds, where commercial papers are almost the same as treasury bills, and the bonds, the corporate bonds, we can equate them to treasury bonds. The commercial papers are really short-term instruments by the corporate or quoted companies. So the fund manager can also use part of the accumulated resources and invest in commercial papers and corporate bonds. The other one that is also very important and forms a good investment platform for the fund manager is banks. The money that we borrow from banks is accessed or sourced from these markets. The fund managers will invest in term deposits or fixed deposits in banks and call and demand deposits with banks. So those are three main investment vehicles all available as for investment by the fund manager. We have the government through treasury bills and bonds. We have quoted companies through commercial papers and corporate bonds. And we have banks through fixed deposits, call and demand deposits. Then we have a fourth one. The unlisted companies can also access the market. Some fund managers will allocate a percentage of that portfolio or the total assets that they have, the total funds that they have gotten from the investors to unlisted or unquoted securities, where those are investments to companies that are not listed in the stock exchange.
Okay.
But collectively, because the money market funds investment are limited to a maximum of 18 months, those investments must, or the fund manager must adhere to that regulation.
Okay, if I could ask, this looks like money which flows in the sight of government. Now, Does the government regulate all other things apart from the treasury bills and bonds?
Yes, by extension, because Capital Markets Authority, that's a public institution. The government, by extension, regulates the finance sector.
Oh,
The Capital Markets Authority is not a private body. SACCOs, as a segment in the finance sector, they are regulated by SASRA. That is not a private body, it's a public body. Banks, as part of the finance sector, they are regulated by CBK. CBK is not a private body, it is a public body. Therefore, the government, by extension, through these regulatory institutions, does control what happens in the finance sector.
Okay, if I could ask, from the recent activities in the country, we have seen the fluctuation of the dollar, and sometimes the dollar goes up and down. Is the money market affected by this fluctuation of the dollar?
Yes, because one, in determination or formulation of the returns or the interest rates that are paid by the fund managers to the investors, because once the fund manager has invested the assets that he has accumulated in the fund, whatever returns they get, the fund manager will distribute those returns to the investors depending on the number of units that you are holding in that fund. And that is after the fund manager has deducted a fee which is pegged to a maximum of 2.5% by the regulator, that is Capital Markets Authority. So in this case, because the fund manager cannot distribute returns that is unable to get from the market. So all those factors that affect the market interest rates will affect the returns by the fund managers. And that is the reason why the money market funds will also fluctuate or keep changing in response to the changes in the factors that affect the market interest rates. And one of the main attributes to those changes is the changes posted by the Treasury bill auction. Money market funds are highly responsive to the market interest rates that are posted by the Treasury bills.
Okay, now the government works through taxation, as we know. So, is there some government earned in these transactions where taxes are extracted from this kind of transaction or in the MMF?
Thank you for the question. Let me rephrase it. A tax is a share of your income, any income, to the government. The government is a key stakeholder in your generation of your income. And therefore, the government takes a share, a predetermined percentage of any income that you generate. There are taxes that are attributable to employment income. There are taxes that are attributable to business income. We have taxes that are attributable to investment income. And this is the case in a money market fund. There are two main forms of investment incomes, or if we make them three. But for a case of a money market fund, we'll be talking of one. A money market fund will generate interest as a return. And the applicable tax is a withholding tax at the rate of 15%. We have other forms of income as we look at other forms of investment. We have a dividend as a form of investment return when you invest in stocks or shares. And that one attracts a withholding tax at 5%. We also have another form of investment income that is a capital gain. And that one only accrues to you once you flip or you sell your appreciated stock. And that one also attracts a withholding tax of 15%. So to narrow down back to the money market funds, we are talking of 15% withholding tax on the returns or the interest that you're getting from the money market fund. And why we call it a withholding tax is that if you invest in a money market fund, the return or interest that you are paid by the fund manager it is the fund manager who will account and pay that tax. That's why it's called a withholding tax. The tax will be withheld by the fund manager and is responsible to pay that tax to the government. And for that reason, when you are filing your annual returns as a taxpayer, you will not include that part of tax because its responsibility and accounting is by the fund manager.
Recently, Safaricom introduced this MMF called ZD. I don't know if you have checked it or you have read something about it. They are saying that you can invest up to a minimum of 100 shillings. Now, for a low class earner or for somebody who wants some few coins who needs to save maybe at the end of the year to have a small project. Let's say, for example, like 1,000. If I invest 1,000 in MMF, will the return really be commensurate to that period of time I've invested the 1,000 for a whole year?
Thank you for the question. And if you allow me to rephrase it, ZD Money Market Fund is one of the most affordable money market funds we have because we have quite a number. ZD is by Safaricom, and the fund managers in the ZD is Sanlam. We have Standard Investment Bank, and we have Ala Capital. We have others that also have a minimum investment amount of 100 shillings. We have Mali Money Market Fund, which was also run at Safaricom with the fund manager being Genghis Capital. And we have Etika Money Market Fund and Etika Capital Limited as the fund manager, also with a minimum investment amount of 100 shillings. If you look at the performance charts as of today, Etika ranks above the two, where Etika today is giving about 14.8% as your daily rate. ZD is giving around 9%, Mali is about 11%. And what happens is that money market funds operate slightly different from one another in terms of compounding, because the most important aspect with money market funds is compounding the return, so long as you don't withdraw from the fund, because money market funds have one key attribute where you can access your money anytime you want it. You can put in money for investment anytime you want it, but there are some limitations depending on when the timing where you are putting the money. So with that liquidity and accessibility as an attribute, compounding only happens when you allow the interest, because you are paid an interest on a daily basis. If you allow that interest that you have earned to remain in the fund, that interest will be treated as an investment, and it will also generate another interest. So in the question of commensuration, whether 1,000 is commensurate, you are getting a commensurate return. You have investments and money market funds. The reason we have so many money market fund products in the market, one, that democratization gives you options. You are choosing a money market fund that suits you best. So if you choose to invest with a particular fund manager's money market fund, you have already analyzed the attributes, the features of that product, the returns you are getting from that product. But back in your mind as an investor, you need to have it registered in mind that the return from the money market fund will be changing from time to time in response to the market returns. And that is more so to say that a money market fund will in most cases give you above what you are able to get from the market in most cases. And a money market fund gives you the primary entry point into investing.
I have a question, something running in my mind. In this country, especially in the state of the economy today, we run everything in emergency. Families in emergency, everything in emergency. So if I choose like today to invest like 1,000 in MMF, and at the end of the day, I have a small emergency, will I be able to access the same funds?
That is a very, very important question. When you are planning your finances as a person, emergencies are events that were not pre-planned, not ordinary day in, day out events. The normal daily events or expenses, you will have tackled them through your budget. What you set aside periodically to build a cushion, a fallback position when you are faced with an emergency, an event that is happening that was not known to you before, that accumulation, that build-up of saving, that is what we call an emergency fund. And that is one of the primary reasons of holding a money market fund account. Because of the same features that I told you, that you are able to put additional investment to that account anytime that you want. You are able to withdraw from that account anytime you want, but there are some limitations. When it comes to investment, where your money starts generating interest, you have to analyze an individual money market fund and understand its features. There is a fund manager who has a money market fund that allows you access, immediate access, anytime. You put your money 8 a.m. in the morning, you are able to access the same amount by 4 p.m. in the event of any occurrence. There is another fund manager who has a money market fund product that has a locking feature. Once you put in your money, it gets locked in that investment for a minimum of 7 days, 14 days. So these are some of the things that as an investor you need first. Analyze, know this product and its features, so that you go for an account that suits you. Because if that particular money market fund has a locking in feature that limits or bars you from accessing that amount for the first 2 weeks, then it means anything happening within those 2 weeks, you will not be able to use this money because you will not be able to access it. But generally, as per regulation, money market funds are free of locking features. But we have some that have locking features in market. And what is required by the regulator is that such requirements need to be communicated to you as an investor before you open that account. And how is this communication done? The communication is through the product brochure or the person that is making it for. But it is your responsibility as an investor to analyze and get to know that product, not relying on other persons. Get to know the product before you jump into investing it. Because as your question was, how easy can one access that money in the event they are faced with an emergency? The only product in the market that gives you that part of a kind of access is a money market fund account. But there are those features that I've told you that you need first to get conversant with before you jump on board. But once the locking period is done, any future additions to that account will not be locked. They will be freely available for your withdrawal. There are other important thing as an investor that you need to look at. Because the question would be, then, why can't I hold my money in my bank account? The most important thing that we overlook is the fact that your money loses value every other day through this animal we call inflation. A money market fund, to distinguish it from your bank account, a money market fund will give you a return, an interest on that money that at least compensates for inflation. While in your bank account, the money that is sitting in your bank account is losing value, its purchasing power through inflation. In a money market fund account, your money gets compensated for the loss of value through inflation by the interest that you are getting. And if you are able to allow that money sit there for long, a money market fund will also be giving you a return that is way above the inflation rate, meaning that you are not only getting compensated for the lost value, you are also generating a return that goes towards growing your money. That is why we call it an investment.
Can I walk on Central Bank counter and say I want to invest in treasury bills and bonds, just straight, and I do a transaction immediately?
While today, things are a bit different. Before the introduction of the new technology, the DAO CSD platform, people used to walk to Central Bank, create your account, and you are able to purchase there. Through a lot of tedious paperwork, you were able to invest in treasury bills and bonds. You used to fill a lot of forms, take those forms back to your bank, they certify, then you take them back to Central Bank. But all that manual process was replaced with a new platform that is called the DAO CSD platform, and that application you are able to access it through your mobile phone. You can go to Play Store or App Store. You are able to get the DAO CSD application. Once you get that application, you create your own DAO CSD account, and in that account, you'll be able to access the treasury bills and bonds that are already on issue, and you can invest directly with the central bank.
Okay, so Safaricom introduced this thing, the ZD, which goes minimum of 100 shillings. So now, if I were to invest in treasury bills and bond, is there any cap?
Unfortunately, you cannot combine ZD because that is a money market fund, and you as a DIY. When you create an account with a fund manager, a money market fund account, you have chosen to invest through the fund manager. So you are putting your money in your own account in the money market fund, then the fund manager is investing on your behalf. On the other side, for selected instruments, especially when it comes to the treasury bills and bonds, you can do it yourself. But notice that when you're investing in treasury bills and bonds, there is a minimum amount of investment. To invest in a treasury bond, you require a minimum of 50,000. To invest in a treasury bill, you require a minimum of 100,000. Sometimes it changes down to 50,000. But the most constant figure is that a treasury bill will require a minimum of 100,000, and a bond will require a minimum of 50,000. The importance of a money market fund is that you may not be able to raise this 50,000. You may not be able to raise this 100,000 at once. So a money market fund gives you a platform where you can park your money. You can keep on saving in the money market fund, accumulating in that money market, to build enough capital for these minimums that are required for other platforms. For you to be able to invest in the treasury bill that require 100,000, and you are only able to set aside 2,000 shillings every other month, you have a money market fund account where you can park. You can keep accumulating the 2,000 shillings every other month to build to the minimum of 50,000 or 100,000 that you require to invest as the minimum amount in treasury bills and bonds. That is one way you can use a money market fund account. But remember, a treasury bill and a treasury bond would require or will tie your capital, that amount that you are putting in there, for a period of time. Because the least you can invest in a treasury bill is 3 months or 90 days.
Okay.
There is another type of a treasury bill that will require you to go for 6 months or 181 days. And the third type of a treasury bill will require you to invest for a whole year. That is 364 days, right? So that means for this period that your funds or capital has been tied in these investments, a bond, the minimum bond you'll get is about 2 years or more than 2 years. You cannot invest all your money in such instruments. you need an amount that is sitting in your money market fund to be taking care of your emergencies. You never know when a catastrophe will come knocking.
Okay. I
So,
get you.
in as much as we can invest directly with the central bank for treasury bills and bonds, and we have other investment vehicles out there, you cannot sweep all the amounts that were sitting in your money market fund towards those other investments. You must have an amount that we call an emergency fund that is sitting in your money market fund account to be taking care of your emergencies. And get this one. If you fail to do that, if you fail to have an emergency fund sitting in your money market fund account and a catastrophe strike, what will happen? You end up destroying these other investments. And the destruction will come in because the liquidation, if you are going to sell that treasury bill, if you are going to sell that treasury bond, you will have to lose some money out of its value to liquidate that money.
I get you now.
So that we call it to build a security, a safeguard to your long-term or fixed investment. Then you need this emergency fund that you can access in part. If you buy a treasury bill of 50,000, which is the minimum amount, you can't sell that treasury bill without losing some value.
Okay.
Because again, it's not divisible. It's not divisible. But if the 50,000 was sitting in your money market fund, you are able to access 10,000, you can access 5,000, you can access 1,000, you can access the whole amount. So the importance of having a money market fund, and actually the recommended amount in that you should always have as your emergency fund, if you are employed, you need about 3 months worth of your living expenses as your emergency fund.
Okay. In some circumstance, let's say in different case whereby you have depleted the amount which was in your account, but you are still holding the bond paper, can it be used by the bank as a guarantee to give you a loan facility?
Yes, even money market funds accounts are used. If you have an amount that is sitting in your money market fund account, or you are holding the government papers, we normally call them papers, you can use those instruments as security to access a loan. But one important thing that you need to know is that for you to succeed in personal finance, as you are building your wealth, one thing that you must run away from is debt. It's debt. Unless this debt is going to generate money, you are going to use this debt to do business. That is the only way you are supposed to go for debt. But one important thing in your personal finance journey is elimination of debt. So that we now don't bring in that feature that you can use your money market fund account balance as collateral or security to get a loan. You can use your debt instrument, the government paper, as security. We will have brought in another aspect that can likely to destroy or to derail your financial journey towards freedom. At the point where we will talk of you being financially stable, you are at a state where one of the main attributes we'll be looking at is getting rid of bad debts in general. But we have debts. If the debt that you're having is generating cash flows, able to repay the debt and its interest and leave something behind for you growing, that is a good debt. That is debt that is doing business. But for consumption, that is a debt that you need to do away with. And the most important thing to do with debts is first stop taking the debt. It is from that time now you can start handling the debts that you are having.
Hi viewers, this thing looks like a power talk. If you want more of this, Mr. Hobrin is having a YouTube channel which I will post on the bottom side of this video so that you can access more of this information that we are discussing here. Before we conclude, we make a conclusion on this show. If I could ask you, can you give us some advantages of MMF versus these other investments?
We need to be in particular.
Okay.
Which other
If I
investment
could
are we
say,
comparing?
like I could choose to deposit my money on a circle for quite some times before I withdraw and do something which I want, or I can use the treasury bill and bond. That's an example. Now, what will be the advantage of the MMF versus the circle?
One important thing that you look at is, or what we need to bring out, is that these are different investment vehicles. And comparing them directly, we are not comparing the same thing. Circles have their mandate and purpose for you to as an investor. Money market funds have their purpose. Treasury bills and treasury bonds, we can easily compare them with MMFs because money market funds, the treasury bills and bonds are one of the asset classes that the fund manager invests in. And that is also available to you as an individual investor if you want to do it yourself. As we had highlighted earlier, you are able to invest in treasury bills and bonds without going through a money market fund. But one thing that is very important is that there is the features of a money market fund that make it good for you compared to a treasury bill. Although the two investment vehicles, they are distinct in the fact that a money market fund is suitable for your short-term goals. For example, if you want to save for your December holiday, the best or the most appropriate platform vehicle to use will be a money market fund compared to a treasury bond or a treasury bill. Another thing is that a money market fund will in most cases give you a higher return compared to what you can get from the treasury bills. If you were to go down to do calculation, you realize, especially the top money market funds, we are able to rank money market funds by their performance in terms of returns that they are giving investors. If you look at the top 5 money market funds, their return will always be higher than what you can get from a treasury bill.
What do you advise my viewers on investing in MMF?
My most important advice will be you need a money market fund as an investor. A money market fund should be one of your investments in your portfolio. You cannot do away with a money market fund. And your emergency funds should at all times be held in easily accessible near cash platforms, and that can only suit a money market fund.
Good people, you need a money market fund. That is one of the best choices you can make in this year 2025. Now we are concluding with this video. Now I would want to say it is good that you choose wisely where to invest. Choose wisely how you invest, where to invest. For more of this, keep in touch. You can always write a comment below this video. We'll be able to receive the information and we'll be able to react to that information. Now, make sure you subscribe, you like, and share this video widely so that other people may receive this information. Thank you.